Hello and welcome to today's webinar, Avoid Costly Financial Mistakes by Selecting the Right Advisor. I'm James Haygood and I'll be your host today. I'll be speaking with my colleague Scott Kornstead, Financial Advisor at Filbrandt Company. Hi Scott.
Good afternoon, James.
We'll begin our conversation in just a few moments. Today is our latest stop on the Filbrandt Company Financial Freedom Tour. This is a year-long educational series of webinars, in-person seminars, campus visits, and special reports written specifically for university professionals. Today, Scott and I are going to explore a topic that's been getting a lot of attention lately, the idea of the fiduciary duty for advisors and how advisors are compensated when working with retirement plans. Instead of focusing on the legal aspects of this, we're going to look at some real-world examples of how working with the right type of advisor can help you avoid making some of the biggest and most common financial mistakes by university faculty members. There is going to be a lot of great information that will help you have a better conversation the next time that you speak with an advisor, so I hope that you stay with us until the end. But before we get into our discussion, if you have technical difficulties at any point during the webinar, please call us at 1-800-431-9740. We have people that are waiting to assist you. We'll be taking questions at the end of the webinar, but you may submit them at any time. To ask a question, use your mouse to hover over the chat icon. Click the chat button and a chat window will appear to the right of your screen, and you may type your question into the chat window at any time. If you'd like to hide that window, you can simply click the X in the upper right corner of the chat window, and you can cause it to reappear at any time by hovering over the chat icon and clicking the chat button again. We also have a special free offer exclusively for webinar participants. I will share the details of this with you after the webinar, so be sure to listen until the end. If you've never been to one of our webinars in the past, you may be wondering just what Filbrandt Company is. We're an independent financial advisory firm that assists university professionals in reaching their financial goals. That's what truly sets us apart from any other financial firm. We know the life circumstances and needs unique to university professionals. We don't sell any financial products, so we're not incented by commissions to sway advice in one direction or another, so you can be sure that you're really getting objective advice. Our firm is a fiduciary, which means that we are legally bound to always hold the client's interest above all others, including our own. We're based out of Madison, Wisconsin, and we assist professors at more than 50 universities across the country. And we've served university professionals for decades, so we have the experience that you're looking for. We work with our clients as an advocate to create comprehensive solutions or your best total solution, taking into account investment planning, retirement income planning, and estate planning, because each area affects the other, so it's important to always consider one's entire financial and life situation. We help organize and improve communication and coordination in your entire financial picture. So before we start to look at some specific examples of big mistakes that can be avoided by selecting the right type of advisor, I want to just briefly review what a fiduciary is and how different advisors operate today. President Obama and the Department of Labor have issued a ruling that will be going into effect over the next couple of years, requiring that any advisor who is working with someone on their retirement accounts to act as a fiduciary. Simply put, that advisor must hold the interest of the client above all others, including themselves. It's kind of alarming when I say that out loud that not all advisors already operate at this level. But that is a distinction that we want to highlight today because it makes a big difference in the type and the level of advice that you are likely to receive. In contrast to the fiduciary standard of holding the client's best interest first, most advisors operate under the suitability standard. What this means is that if you are working with an advisor that is selling you investment products, the products that they want you to buy have to be suitable. This is a huge distinction because the investment that is suitable does not always have to be in your best interest, and it could very well be the investment that results in the largest commission for that advisor. What makes this even more confusing is that the fees and the commissions being paid to advisors are often done so behind the scenes. I meet with many professors who tell me that they're working with an advisor who doesn't charge them any fee. This sounds great, but when you look at what's really happening, That advisor is being paid commissions and fees behind the scenes by the investments that they are using. Now, I want to pause for a moment because this is where we're going to dive into how big of an impact the type of advisor you work with can have for you and your family. Working with an advisor that sells products and is not a fiduciary can be a perfectly good resource for many people. And there are a lot of good advisors who operate like this. But for university faculty members, this is how some of the biggest financial mistakes can happen. What it really comes down to is the idea of below the horizon versus above the horizon planning. Below the horizon planning focuses on the numbers, the details, and the investment products. Above the horizon planning focuses on the goals and the needs of your family. If you work with an advisor who is only motivated or incented to spend their time below the horizon, it reduces your chances of reaching all of your family's needs and goals. A good advisor will start with the above the horizon planning. They will take into consideration all of your needs and goals and act as an advocate for you. Scott, maybe you can think of a recent example where you have worked with a client on some above the horizon planning and acted as an advocate for them.
Well, certainly, James, and thank you, and welcome again, everyone. The story that I would like to relate is a client that I work with, and for today's purposes, we'll call him Bob. Bob has been with his university for over 30 years and spends countless hours researching cures for cancer. He also travels across the country and now the world speaking to groups about his research. Like many of you listening today, his life is hectic, to say the least. Because of this, his personal time is very important to him, and he enjoys spending it with his wife of 30 years, with his children, and now with his grandchildren. One place they enjoy this time is a cabin on a small, quiet lake. They have owned this property for 20 years, and some of the best memories of their children come from this property. I'm sure many of you listening today can relate. Perhaps it is not a cabin, but somewhere where you go to escape the pressures of your daily lives. I visited with Bob recently. Over the course of our relationship, we have been discussing many of the above-the-line topics that James mentioned. In Bob's sake, it's his busy life, the importance of family to him, and also this cabin getaway. My agenda for this particular meeting included reviewing his estate plan, as it had been several years since it was completed, and also talking about a large cash position and what he should do with it. The agenda items were agreeable, but I added a question at the beginning of our meeting that I always ask of our clients, that being, what else is on your mind today that I can help you with? Bob thought for a minute and then provided an update to me on his cabin property. Recently, the lot on one side of them was purchased and a massive cabin was built right up to the property line. Needless to say, this reduced a bit of the tranquil feeling of visiting this property. He continued by letting me know that he was very interested in buying the other lots next to him to ensure that at least that side of his property remained peaceful. He had spoken to the owner in the past, but the land had never been for sale. He inquired that perhaps he should use the investments from his retirement plan to pay for this land, since he is still working and will have a large state pension and his spouse's Social Security to cover their retirement income needs. He also mentioned the cash position that was on the agenda. Each of these could provide the necessary payment for the land, but is this the best option? Knowing the above-the-line feelings on family, busy lifestyle, and the importance of his cabin, I knew we had to find some type of way to make sure that that lot remained open. The idea of the retirement account would just add a large tax bill, as any withdrawal there would add to his taxable income for the year. This same retirement account is also being viewed as an asset for either charitable planning for the future or for his children to receive in his estate. So that was not a viable alternative. The cash could certainly be used, but that would deplete nearly all of his cash on hand. What would happen in the event of an emergency? What if one of his children or grandchildren needed some sort of assistance? So perhaps this was not the best idea either. We ended up recommending that Bob have a talk with the owner of the lot to feel out an interest in selling, and at the same time inquiring if he ever does look to sell to let Bob know. Ultimately, we went a bit further and had an attorney draft a document called a right of first refusal on the property. It was signed by both parties, and Bob also added $2,000 of earnest money to the deal. He now has peace of mind that the lot will not be snatched up and built on. He also has no large tax bill to pay, as he did not take any distribution from his retirement plan, and his cash on hand he is also maintained in the event of an emergency. So why does all of this matter? Let's imagine Bob was visiting someone who was compensated based on selling a product, whether it's a mutual fund, a stock, an annuity, or even a CD. If he asked the same question, would they have provided the same advice? Perhaps. but would they have the motivation or incentive to offer different advice, especially on the cash that was to be put to use? Bob compensates our firm for advice, not to purchase a product. We also operate under the fiduciary duty, meaning advice has to be in the best interest of Bob. Would a mutual fund have been suitable for Bob in this situation, especially on that large cash position? Certainly, but that is probably not the solution that is in Bob's best interest.
Thanks, Scott. I think that story is a great way to demonstrate how the type of advisor you're working with really can affect the level of service that you can expect to get.